This is Barry Knapp with Ironsides Macroeconomics. It's Monday morning, July 8th at 7 a.m. Mountain Time. Our note released on Saturday morning was titled Slowdown. We also had a note that we released on Tuesday titled Up Like a Rocket and Down Like a Feather. It was a preview of the employment report on Friday, and then that was to be released on Friday. And then, of course, after it was released, we titled our note Slowdown as an acknowledgement that growth has really decelerated throughout the course of the second quarter. So the first section of the note that was released on Saturday was titled Slowdown, walking through the broader macroeconomic themes. We then moved on to discuss that employment report and titled that section Time to Cut. We do think it's time for the Fed to focus on the employment part of their mandate. We then wrote a section titled Trumpflation. We took the letter that the 16 Nobel Prize winners, the 16 Nobles we call them, and kind of picked it apart a little bit. We do remain in the structural bond bear market camp until and unless the Fed starts, not the Fed, the federal government starts running primary surpluses, and neither candidates indicated they're about to do that. But we did want to walk through the elements of this, we would describe it somewhat hysteria about Trump causing some big inflationary spiral in 2025. And then made some tactical sector changes. So first on the slowdown front, the Atlanta Fed GDP tracker, which we don't like very much at the beginning of the period, we think it gets misused, but by the end of the quarter, and we are done with the second quarter, we would note that that's fallen from 4% down to 1.5%. And if you look at the proxy within the employment report for GDP, the aggregate hours index, that has only increased at a 0.3% rate quarter to date. Now, typically to get GDP, you add an estimate for productivity to that, but it's still, we're talking about very sluggish hours worked in the second quarter. And the unemployment rate has now triggered the SOM rule. The 3-month average, rounding to only 1 decimal point, is up 0.5% from last year's low. And that typically means we are either in a recession or about to be in a recession. It's not our forecast per se, but we don't think the Fed's forecast of it just going to 4.1 and staying there makes a heck of a lot of sense either. They're likely going to need to start easing policy. So those were sort of the lowlights of the employment report. We would note one of the things we wrote about was that government employment has been the main driver, either direct or indirect, through the sectors that it's pumping money into, like construction and manufacturing. That was again the case. We would note other leading indicators like net revisions are quite negative. Temporary employment is down almost 8% on a year-on-year basis. It fell 47,000 jobs on the month. And this just looks like the underlying fundamentals of the labor market are getting quite weak. The only jobs being created are in the government sector or in healthcare, acyclical sectors, so to speak. So moving on to Trumpflation, as we said, we think the real way to get the bond market stabilized over time would be for the government to start running a primary deficit. Our thesis is that the Fed's going to be slowly unwinding their balance sheet over a long period of time, much like the unwind of interest rate caps from World War II. And the government's going to continue to run deficits, and that's going to push bond yields higher over time. We're in a structural bond bear market. But we would note tax cuts do not have the same effect as spending does. And we're not nearly as concerned about tax cuts being inflationary. That's not the right way to think about it. We go through that in details in the note. We also don't think tariffs are likely to be inflationary. Quite frankly, they could be more deflationary. And we did demonstrate how the trade war in 2018 and 2019 caused the global manufacturing recession and capital spending to weaken. And then moved on to Fed independence and the idea that Trump's going to fire Powell and put a puppet in his place and walk through the tactics and how that he won't be able to actually do anything about Powell until 2026. He could demote him, but then he would have to name someone else on the board as Fed chair in the interim. We do think that there are structural problems with the Fed, but remember, to get any real legislation in place would require a filibuster-proof majority in the Senate. No one's going to have that. We're not going to see any big structural changes to the Fed. And quite frankly, the leading candidates to become the next Fed chair, people like Kevin Warsh and Kevin Hassett, are unlikely to be uber doves. So we think all that's just a lot of hysteria from some politically motivated academic economists that, quite frankly, aren't very good at forecasting or really understanding the political economy in our view. So finally, we made some sector changes. This is the part where you really ought to be a subscriber to get in on all this. We cut our overweight in industrials a bit going into this quarter. We added some of that back to tech, which has drifted away. Our 27% allocation has drifted away from the index benchmark because the index, the sector has performed so strongly. It's gone from 30% of the index up to 33%. So we synthetically covered part of that short. We're now at 30. And we added a little bit to healthcare, which we think would be a beneficiary of a Trump presidency, which is obviously the highest probability outcome right now. So just to be clear, this wasn't a whole big defense of Donald Trump. This was just walking through these elements of inflation. And you can get all the details if you become a full paid subscriber. Barry Knapp from Ironsides. Have a good week, everyone. Thank you.